CNBC TV18, celebrating 15 years of leadership.
Welcome back to Indianomics. Why have bad loans taken a quantum leap in the third quarter to nearly 6% of the total loans of the banking system? Why are borrowers failing to pay at such a fast clip? And what kind of borrowers are defaulting? Does the banking system need some emergency external help to stem the tide? To answer all these questions, I have with me Diwakar Gupta, ex-Managing Director of State Bank of India, and S.C. Bansal, the former Chairman and Managing Director of Oriental Bank of Commerce. Gentlemen, thank you very much for joining me. Well, Mr. Bansal, let me start with you. What is your sense? Why this quantum leap with more and more bank chairmen telling us that 60%, 70% of their fresh NPLs are actually their restructured assets toppling? What's going wrong here?
You see, Latha, we must understand why these NPAs are coming up so sharply in the last 18 to 24 months. See, let us go back into 2005-06 when most of these infrastructure projects were conceived. There was a particular IIR in mind depending upon the economic growth, and we were growing at 8.5%, 9%. Unfortunately, when we came in 2008-09, when most of these projects were supposed to deliver, what happened? There was a meltdown, global meltdown, and Indian economy started slowing down. So the calculation of IRR went haywire, plus interest rate starts moving up.
Yes.
I remember in 2010 we migrated to base rate. It was 8% and it went up to 10.75. At that stage in 2009-10, we allowed one-time restructuring, general restructuring, left and right, without going into the merits of the case. With the result, what happened in 2011-12, all of a sudden these performance of these projects come up for testing. And slowly, one by one, these assets starts falling into NPA category because the IIR was not up to the mark, and plus interest rate was already moved up from 8% to 10.75. So these two were major factors. Number two, this agriculture debt waiver also impacted a lot. It vitiated the atmosphere of repayment, and there was a negative impact. Third reason, our NPA resolution system is so bad that public sector bank refrain from compromising, because then there are so many questions. So all these three things put together are adding up to the NPAs. Okay.
Well, let me take them one by one with Mr. Gupta. The system has 6.5 lakh crore of restructured assets. Way back in 2011, 12, 13, when we were questioning the chairman, they said, how can you say all the restructured are NPLs? Barely 10 or 15% have become NPLs. Do you think now we are in danger of like 50% becoming NPLs?
Well, Latha, we need to understand that there was a downturn. And there was restructuring which was done assuming that we were coming out of that downturn. That coming out of the downturn has now been delayed by 2 years. We were talking this in 2013. We are in 2015. Even today, while the markets have run up on the basis of a positive sentiment, on the ground you don't see much relief. In fact, there are many who say it's actually marginally worse. So whatever you restructured in the hope that you would have revenues in 2014 and 15, that has not been realized. It is but natural that these restructured assets would therefore become non-performing or continue to remain stressed. The question therefore is to go beyond the letter and look at the spirit of the NPAs. I think that's the only resolution. The governor in his bi-monthly review recently used that word. He's saying there should not be a stigma attached to NPAs. I think that's really the crux of the problem. Nobody is saying that you should evergreen it or call a substandard asset standard. You should be willing to call it substandard, but know that it is viable. Therefore, you provide more and still continue to help the project. That is where there is not enough, I should say, appetite for decision making.
Should it be moral suasion? Or should it be capital? Why is a banker not doing it if the governor himself is saying that go ahead and lend to an NPA?
Because as Mr. Bansal said, it's one thing at a macro level to agree what is right. It is another at the micro level to wonder how much of a risk you are taking in taking that decision.
Okay.
Now, you will never be able to change the CBI, CVC, RTI structures. Those won't go away in a day. But I have been saying this for a long time now, and I think the governor, the Reserve Bank, the government, they have to find a one-off mechanism by which they will be able to create an empowered body that can force these decisions across at least the public sector banking space. It may be on a one-off basis, it may be for 200 units, but it has to be done. Until that is done, you know, board-run companies, each going to its own board, each having its own set of people to assess a risk, you can never have congruence. And delay is death. There is no accountability for that delay, except that the borrower suffers.
No, I think that's exactly what Mr. Bansal is also hinting at. You know, if you have the combined force of an RBI and the government forcing banks to take decisions in cases which can topple over, then perhaps you know, you're going to save the 6 lakh crore from, you know, largely going into NPLs. But before I get to Mr. Bansal, this is another issue in which you are not involved, so I'll treat you as neutral party. So many banks don't have a chairman for so long now, and big well-run banks like Bank of Baroda, no chairman for 6-7 months now. Punjab National Bank, 3-4 months now. Canara Bank, and these are large banks being run by 1-2 EDs. You think this itself topples over some cases into NPLs?
No, it certainly does. I think there is no second answer to this question. There are large hierarchical organizations, when they are in the government sector more so, they all look up to that one person for a cue on what is to be done. And if that one person is not there, the next person is certainly never going to step into the shoes of the number one with the same kind of authority, because he doesn't know tomorrow where he will be, under whom he will be working. There is that uncertainty. I mean, even when there are CMDs, getting 8 or 10 public sector banks to come to a consensus is hard. You can imagine how much it complicates and compounds the problem if the top post itself is vacant for long.
Okay. Mr. Bansal, you know, the hope is that as and when after this delay, the chairmen are appointed, they are going to get longer tenures. Do you think the new system of chairmen or CEO and chairman that is supposed to be coming up now will be better able to resolve? You will get more decisiveness in decisions hereafter, or you're not quite sure of that?
See, Latha, this way we will be able to help in taking futuristic decisions. Now, whatever has happened already, we need to resolve it first. See, whatever the NPA are there in the system, return of assets are there, plus restructured assets which are bound to fall into the stress category, maybe after 6 months, maybe after 24 months. And you see, it is like tsunami of NPAs. We need to resolve this. Most of the accounts, State Bank of India, PNB, Bank of India or Bank of Baroda are the leader. Now, there are 7-8 banks involved in it. Now, it is very difficult for Vijaya Bank chairman or Dena Bank chairman to get in touch with the State Bank of India chairman and to arrive at a consensus how to resolve an NPA account. To my mind, either the Government of India or the Reserve Bank of India, under the chairmanship of either Deputy Governor or Additional Secretary, can have a committee. They can take ownership of 100 top NPA accounts and return of accounts and resolve these accounts. See, close to 1,20,000 worth of assets have been written off in the banking books. Even if we are in a position to recover 40% or 50%, this 50,000 crore will straight away add to the net worth of the public sector banks. And similarly, NPAs, whatever be the NPAs, close to 3 lakh crore is the NPA. Now 30% is the provision coverage ratio. If we can sincerely resolve large accounts, I think it will go a long way in improving the net worth of the public sector banks, improving the share value, and then you need not provide the capital. What we are doing is, on the one side, the share value is getting beaten up, and every day you see, today if share is quoted at 200 rupees, tomorrow it will be quoted at 170 rupees. I am giving a specific example of PNB. The share price was about 200 rupees when the results were not announced, and today it is at close to 170. So if we can improve the net worth of the bank, like resolving these NPAs, I think we can do a lot of service to the public sector bank and to the economy.
Now, I'm taking on board this very strong decision that's coming from both of you, that you now need a one-time, push from both the shareholder and the regulator to ensure that a vast bulk of the 6.5 lakh crore of restructured assets don't topple over. The other issue is what the governor has suggested in the policy statement, that you don't have to write a loan as NPL if you change the management. Your thoughts, Mr. Gupta? I mean, there are incompetent managements. Do you think this will make bankers proactive?
No, I think what the governor is saying is basically to go for the substance rather than the form of a given regulation. And I think all the relief that has been given on DCCO so far as well is to recognize the fact that there are things beyond the control of a promoter and they should not come to hurt the promoter or the enterprise.
But here you are saying the promoter is hurting. So change him and I will allow you not to mark it as NPA.
Right. So I think the argument can be turned around on its head to say if there is a new promoter stepping in, that promoter should not come in with a handicap.
Yes.
So I think that was the idea. That's the spirit. But again, it's the same thing, It's absolutely fine. Whatever dispensation you give.
Will bankers use it, or will, if at all they find the courage or the decisiveness to use it, it will get into litigation?
No, I don't think it will get into litigation. Litigation can happen anyway, irrespective of the classification of the account. Okay. The litigation will be on the substantive decision of changing a management rather than its classification.
Yes.
So we don't need to worry too much about it. But my fear to your earlier question, whether it will make things any better, my unfortunate assessment is no, marginally. Because the problem today is not in providing an incentive. The problem today is giving a hedge to the decision makers that they will not be questioned for bona fide decisions and have even their integrity questioned.
Okay. Well, now again, since you are an outsider to the system, Mr. Bansal, do you think separating the decision making as MD and CEO and chairman, of course, in most cases chairman have not even been appointed, is going to in any case worsen the situation because you will lack decisiveness?
Obviously, see, in the public sector, or rather even in private sector, everybody looks at the top for critical decisions. When there is nobody at the helm of affair, the people very conveniently avoids taking decision, and the whole system gets slowed down. With the result, what we are seeing is that the EDs in most of the few banks, see, the EDs are even as against 3 EDs, there are 2 EDs, as against 2 EDs, there are 1 ED. And I know a bank which is being run by only 1 ED. There is no chairman, there is no second ED.
No, my separate point was, no, Mr. Bansal, my separate point is the new regime wants the position of chairman and MD separated. And it has already been announced for some banks. Will that weaken decisiveness even further? Splitting of the post.
See, although we have announced it to separating the post of the MD and chairman, but still the guidelines have not been formalized, no advertisements have been issued. I don't know when the new chairmen will come and when they will take over, and what type of people will get at the helm of affair, whether they will be in a position to really guide the board. Again, important is, Latha, in public sector bank, there are 5 set of directors. Number 1, employee director, officer director, Reserve Bank of India director, Government of India nominee director, plus directors appointed by the shareholder and directors nominated by the Government of India. It's very difficult to coordinate the difference of opinion by the chairman or the CMD, whatever you may say, unless you overhaul the whole process and professionalize the board. I don't think anything materially can be changed at the ground level.
Mr. Diwakar Gupta, last word. We have just about a few minutes.
Well, Latha, I think on the same question, why was this step required? Because we need better governance of banks. How will better governance come? You should have boards which are more empowered. Now, after those boards are empowered, they will look after policy and strategy. And the CEO will do execution. So the CEO should be responsible to the board.
Yes.
Now, that is what the PJ Naik committee is all about.
Yes.
Now, so A follows, C follows from B and B follows from A. You have to first do A, then you have to do B, only then C will be useful. Now, you have gone ahead and done C.
C first.
Today, you have two people appointed by the President of India, the chairman and the CEO. Obviously, it's boardroom conflict because nobody is accountable to the other. The CEO can pretty much do what he wishes. He can be respectful. He can say yes to whatever the board says, and then he can do whatever he wishes to. The entire rank and file will really take a cue from what the CEO is saying. And therefore, until you have a CEO accountable to the board, this is actually worse than the earlier arrangement.
Okay, well, we have to wind up this conversation, but I've got 2 or 3 at least immediate takeaways for the government of India. One, that the regulator and the government have to post-haste sit together and at least resolve the top 100 or top 150 cases, or force the banks to take a decision on them, or this NPL issue can become a systemically dangerous issue. The second one, of course, is perhaps the more long-drawn one, which is that boards need to be professionalized and then the CEOs can be made accountable to the board. But for that, perhaps PJ Naik's other recommendation that the government stake should go a tad below 50 so that the CVC and the other investigative agencies are not breathing down the neck of the CEOs could become useful. But those are longer term questions. First things first, we just need to resolve the top 100 NPLs, top 100 restructured accounts today if it isn't to become a systemic issue. Thank you very much, Mr. Bansal and Mr. Gupta, for joining me. That's it on Indianomics.